Good afternoon to Manila and good morning from London. This is David Marsh, Chairman of OMFIF. I'm very pleased that we are being joined today by the Governor of the Central Bank of the Philippines, Benjamin Diokno, who's been in office now since 2019. And he had a remarkable career before that, looking after budget and management in the government, so well equipped to deal with this period of crisis that we've been enduring over the last 18 months. We seem to be coming out of this, and the title of your presentation is indeed The Recovery Taking Place in Philippines. It's been quite a stellar transition. You've been tweeting about it lately, Governor. I can see that as well, with some good news about inflows just in the last few days. And I'm very pleased that we're being joined also by three of the four deputy governors. That's Francisco Daquila, who's in charge of the monetary and the external sector. We have Chuchi Fonacher, who's looking after financial supervision. And the third colleague, one of the deputy governors, Mamerto Tangunan, who's in charge of the very important part of the bank dealing with payments and currency management. So welcome to all of you. Very pleased that we can be carrying out this conversation with the governor, as we call these regular features. And I'm going to ask you now, Benjamin Diokno, really to take us through your presentation, and then we'll have a question and answer after that. So welcome, Governor. Thank you very much for coming, and over to you.
Thanks, David. Officers and staff of the Official Monetary and Financial Institutions Forum, fellow central bankers and regulators, other public and private sector guests, ladies and gentlemen, a pleasant day to all of you. I thank OMFIF for inviting me again to speak before your stakeholders. My task here is to update everyone on economic developments in the Philippines a year and a half into the global COVID-19 pandemic. My presentation will be divided into three parts: where the Philippine economy is, where we envision the Philippine economy will be, and how we intend to reach our desired destination. The Philippine economy has started to recover, growing by 11.8% in the second quarter of 2021, thus ending the pandemic-induced recession. The second quarter growth was not solely due to base effects. Growth was broad-based, driven by manufacturing, construction, and wholesale and retail trade on the production side, and by household consumption, public construction, and investment in durable equipment on the expenditure side. Unemployment rate improved to 6.9% in July this year, the lowest since the pandemic's historic high of 17.6% in April last year. Manufacturing activity was on expansion mode, with the Purchasing Managers' Index at 50.8% in June and 50.4% in July. But it suffered a temporary setback in August owing to the imposition of stricter lockdown to curb the spread of the Delta variant. By the way, the decline in PMI is Asia-wide. Meanwhile, inflation rose to 4.9% year-on-year in August. The year-to-date average inflation rate of 4.4% in the first 8 months is above the upper bound of the government's annual inflation target of 3%, plus or minus 1 percentage point. The increase in headline inflation was driven mainly by higher price increases of key food items, particularly vegetables and fish, due to supply disruptions from damages caused by monsoon rains in parts of the country. Meanwhile, increased electricity rates due to higher generation and transmission charges, along with increased prices of LPG, contributed to the rise in year-on-year non-food inflation. The latest CPI outturn is consistent with the BSP's assessment that inflation could settle close to the high end of the target range in the near term before decelerating back to within the target by year end. In 2022 to 2023, Inflation is expected to decline towards the midpoint of the target, supported by the continued and timely implementation of non-monetary measures and reforms to address directly supply-side pressures on key food items. Our inflation projections are in line with expectations of relevant observers. Given manageable inflation and in support of economic recovery, the central bank kept policy rates steady during the policy meeting last August 12th. Latest figures in actual and pledged investments are very encouraging. Foreign direct investments jumped 40.7% from January to June. Foreign investment applications approved in Q2 2021 grew by 45.5%, reaching 22.5 billion pesos or $445 million. The top 4 nationals investing in the country came from UK, South Korea, USA, Netherlands, and China. Trade has recovered from last year's contraction. Imports grew by 24% in July, with bulk of the country's imports being raw materials and intermediate goods. Imports recovery is a welcome signal of rising investments in anticipation of higher demand. Similarly, exports jumped by 12.7% in the same period. Overseas Filipino remittances in 2020 reached almost $30 billion, slightly less compared to 2019, defying forecasts that it will fall by double-digit rates. During the first 6 months of this year, remittances grew by 6.4%. The uptrend in remittance inflows is expected to continue as COVID-19 vaccination levels increase domestically and in OFW host economies. Travel restrictions is further and countries safely return or rather open to foreign workers. External accounts remain robust. Gross international reserves are equivalent to more than 1 year of imports, versus the received doctrine that 3 months worth of imports is already sufficient. The banking system remains stable and resilient, thanks to regulatory reforms over the past 2 decades. Loan quality remains manageable, with non-performing loans ratio of universal and commercial banks at 4% as of end June this year. This is far from the double-digit figures seen in the aftermath of the Asian financial crisis. Banks have ample buffers with a capital adequacy ratio of 17.4%. This is well above the international standard of 8% and the central bank's regulatory requirement of 10%. All these indicators show that the Philippines is well into the recovery process, aided by COVID response measures from the fiscal and the monetary side. The central bank implemented extraordinary measures to ensure ample liquidity in the financial system, support orderly functioning of the financial market, and shore up market confidence. These measures include a mix of decisive monetary policy adjustments, liquidity-enhancing measures, and regulatory relief and forbearance measures. The central bank has so far infused 2.2 trillion pesos, or approximately $44 billion, equivalent to about 12.5% of GDP in liquidity to the financial system. To maintain stability of the financial system and to ensure public access to financial services, we implemented a long list of measures to ease the impact of the crisis on the balance sheet of banks, so they can help their crisis-hit customers as well. With the Philippine economy's recovery underway, we remain optimistic that the country's medium and long-term growth prospects remain robust. Nevertheless, we recognize that the road to full recovery is not going to be a walk in the park. With the spread of the more contagious Delta variant in many Asian countries in recent months, the Philippines' COVID cases have also spiked. We are proactively containing the spread of the Delta and other variants through a risk-based approach in quarantine restrictions, allowing important businesses to operate, including public transportation, but restricting non-essential activities. We're also using this period to vaccinate as many as we can. The lockdown is expected to dampen the Philippine economy's nascent recovery, but only temporarily. There is basis for cautious optimism. Nationwide vaccinations have accelerated. The Philippines is now vaccinating more than 400,000 individuals per day. At this rate, the country may achieve population protection by the fourth quarter of this year. Moving on to the second point on where we envision the Philippine economy to be. Before the pandemic, the Philippines was poised to transition from low middle income to upper middle income status in 2020. We also have achieved great progress in poverty reduction. Poverty rate fell from 23.5% in 2015 to 16.7% in 2018 and was poised to drop further to 14% by 2022. Unemployment rate was down to a record low of 4.5% in October 2019. The economy posted 21 years of uninterrupted growth up to 2019, expanding even at the height of the global financial crisis. These achievements were made possible in part by price and financial stability, aided by the central bank's sound monetary policy and financial sector regulation. With the Philippine economy starting to recover, the national government's fiscal and public health measures remain crucial in sustaining the momentum. The road to economic recovery requires purposeful and coordinated efforts, a whole of government approach. The central bank, complementing the stimulus from the fiscal side, will continue supporting the economy until the recovery fully gets underway. Looking ahead, we do not aim to simply regain the economic losses from the pandemic. We aspire for a post-COVID-19 Philippine economy that is stronger, more resilient, more technologically advanced, and more inclusive than ever before. The central bank supports the realization of the post-COVID-19 economy through commitment to its price and financial stability mandates and push for innovation in the financial sector. The Philippines also aims to be a technologically advanced economy that has high regard for the environment. On sustainability, the Philippines last April submitted its commitment with the UN Framework Convention on Climate Change to reduce its projected carbon emission by 75% by 2030. By then, we want sustainability deeply ingrained in the consciousness of Filipinos and factored in by businesses in their operations. Now, on my third point, on how we are moving towards our desired destination. The Philippines is pursuing its goal in many ways, but three are on top of my mind. First is by further liberalizing the economy and making it even more investor-friendly. The Philippines is a signatory to the Regional Comprehensive Economic Partnership, or RCEP, a mega free trade deal signed by select Asia-Pacific economies in November last year. RCEP signatories account for nearly a third of global output. Once it takes effect, RCEP will open the gates of member economies to much more trade and investments. RCEP is important for the Philippines, more so because it will drive growth of our micro, small, and medium enterprises, which account for 2/3 of employment in the Philippines. Businesses operating in RCEP economies will be able to source raw materials within the bloc at cheaper cost and export finished goods to other RCEP members under preferential arrangements. Also, RCEP will help the Philippines attract export-oriented firms that want to take advantage of free trade with our neighbors. There is much economic energy waiting to be unleashed in the coming period. Our recovery will also get a boost with the implementation of the CREATE law, or Corporate Recovery and Tax Incentives for Enterprises. This is the largest economic stimulus program for businesses in our recent history. The CREATE law provides an immediate 10 percentage point cut in corporate income tax rates of our micro, small, and medium enterprises, from 30% to 20% of profits. The rest of the corporations enjoy a 5 percentage point reduction, from 30% to 25%. CREATE grants tax relief annually to the corporate sector to sustain employment or use for reinvestments. Publicly listed companies acknowledge that CREATE helped them maintain or increase their profitability and their ability to cope with the pandemic. In addition, the CREATE law provides flexibility in granting fiscal and non-fiscal incentives. This introduces an enhanced incentives package that is performance-based, time-bound, targeted, and transparent. Through CREATE, we see an opportunity to draw in high-value investments by incentivizing industries that will introduce new technologies and innovations and create more jobs. Moreover, the President has certified as urgent 3 bills seeking to further open the Philippines to foreign investors. These bills are in advanced stages of the legislative process. These include a bill that seeks to lower the capitalization requirement for foreign retailers, a bill that redefined public services to essentially lift foreign ownership restrictions in sectors like telecommunication and transportation, and a bill that seeks to allow foreigners to operate small and medium enterprises in the country, provided they either bring in advanced technology or employ a minimum number of Filipinos. On the part of the central bank, we support investment promotion through a regulatory environment that is welcoming to foreign investors and technological innovation. In 2014, we liberalized foreign banks' entry into the Philippines. As a result, to date, there are 29 foreign banks in the country, of which 24 are operating as foreign bank branches and 5 as foreign bank subsidiaries. Since the issuance of the regulatory guidelines for the operation of digital bank guidelines in December 2020, the central bank has so far approved license applications of 5 purely digital banks. Last year, we launched the Digital Payments Transformation Roadmap. Under the roadmap, we target half of financial transactions to be done digitally and 70% of Filipino adults to have financial accounts by 2023. The roadmap entails leadership from the BSP and collaboration among industry players in putting up safe and efficient systems that allow electronic fund transfers. Financial technology accelerates payment processes and makes affordable financial products and services accessible, thus providing income growth opportunities to more citizens. The second way the Philippines is pursuing its long-term goal is through infrastructure development. Over 5,000 infrastructure projects are listed in the country's public investment program for 2017-2022, with a combined cost of 6.7 trillion pesos, about $130 billion. With the government's aim to usher the country's golden age of infrastructure, public infrastructure spending has risen over the years from 3.9% of GDP in 2016 to a projected 5.1% this year. Infrastructure flagships projects include railway systems, airports, roads, water systems, and information and communication technology development. The BSP is contributing to infrastructure development through regulatory measures, such as by increasing the single borrower's limit, as well as deepening of the capital market that make it easier for infrastructure companies to finance projects. Finally, another way the Philippines is pursuing its long-term objective is through policies geared towards inclusivity. Besides infrastructure development, the other objective of the Philippine government is to invest in human capital development. Government spending for social services takes the lion's share of the national budget. For this year, it accounts for 37% of the national budget with 1.7 trillion pesos or $33 billion allocation. This budget is used to fund recently enacted laws on universal access to university education and healthcare. Investments in education and healthcare help the Philippines, whose population has a median age of 25 years, harness its demographic advantage. Having a young population in an aging world is an asset, provided we are able to mold them into competent and agile workforce. The BSP actively contributes to the inclusion agenda. Regulations and advocacy programs meant to ease access of microenterprises to credit and other financial services are in place and are constantly revisited for enhancement. The central bank likewise implements financial literacy programs that improve knowledge of Filipinos in savings and investments. In closing, I would like to highlight 3 takeaway messages. First, the Philippines' economic fundamentals remain sound. Inflation is manageable, external payments is robust, and the banking system remains resilient and stable. Second, as indicators show, the Philippines has begun the recovery process. The central bank will keep its policy settings and regulatory relief measures supportive of the economy as needed. The withdrawal of policy measures will only be done once full recovery is underway. And third, the monetary authorities will continue to provide an enabling environment for the attainment of the Philippines' long-term economic goals, such as through price and financial stability, and the promotion of financial digitalization and sustainable finance. Thank you very much for your attention, and I look forward to the Q&A.
Thank you very much, Benjamin. Thank you, Governor Diokno. That's a really comprehensive assessment. And I was struck actually by the number of similarities there are in your phraseology, the way that you're going about this recovery to the central banks in the Western part of the world. And it does show, doesn't it, that there is a around the world commitment to good, sound policies that we see in your country as well as in many others. You mentioned inclusivity quite a lot. And I just wanted to start off by asking you, how well do you think the Philippine society as a whole has weathered this crisis?
Could you repeat that, please?
Yes, you mentioned inclusivity a lot. How well do you think that the Philippine society as a whole has managed to cope with this crisis?
On the crisis, we recognize that this is basically a health crisis with economic implications. And the way to address the crisis, last year, we don't know a lot about the virus, right? So we have to resort to lockdowns, and that actually caused the economy to decline significantly. So we have to, first of all, because of the lockdowns, we have to provide some assistance to those who were locked down. Poor and middle-income families were provided some sort of accommodation. Now, but even before the lockdown, we already are committed to digitalization. I think that will help a lot in financial inclusion. And then also we have projects like we come up with the national ID, and that is on stream. And we also have invested significantly on public infrastructure. As you know, I serve as budget secretary under 3 presidents before, and I knew that in the past, for the last 50 years, we did not spend enough money for public infrastructure. So under this new administration, we committed to spend at least 5 to 7% for public infrastructure, 5% of GDP for public infrastructure. So that's one thing. It is what we need to move the country forward, increase the capacity of the economy. And so that's one of our projects. We call it Golden Age Infrastructure. And that sounds like what Biden is doing right now. And so even before the COVID, and we also were committed to invest in human capital, education, and health, because our main strength at the moment is our young population. Median age, as I mentioned earlier, is 25. So if we can only train them and make them an agile workforce, that will be an asset in an aging world.
You do seem to be using the crisis in a very positive way to make these big, fundamental, important changes in the Philippines economy. There has been a lot of stimulus, clearly, for the reasons you mentioned, including by the central bank. You mentioned liquidity help, 12.5% of GDP, a big amount. And you say you're not going to withdraw this stimulus until full recovery is underway. When do you think that is likely to be, that you will start to withdraw some of these extraordinary monetary measures?
Yeah, you're right. Last year, we were, I think, one of the first central banks in the world which acted swiftly. We cut our policy rate by 200 basis points and our reserve requirement by the same amount. As I mentioned, we introduced liquidity amounting to around $44 billion US. Okay? And so the question is, when are we going to withdraw some of these measures? Well, we closely monitor the situation. We look at present statistics, and we estimate that we'll be back to where we were before the COVID by the last quarter of next year, or the first quarter of 2023. So we monitor both the output and the employment. And then I think will be fully recovered by the fourth quarter of next year or the first quarter of 2023. Maybe that's the right time for us to talk about withdrawing some of our policy measures.
You mentioned also the whole of government approach, which the Philippines is following. Do you think the central bank, under your stewardship over the last 2 years or so, has learnt better to work together with the government, bearing in mind that you were, as you say, the budgetary secretary beforehand? So is there now more cohesion, more coordination between the central bank and the government?
You're right. Even before the pandemic, we have a high-level interagency committee consisting of the Department of Finance, the Department of Budget and Management, the central bank governor, and the executive secretary, and also the planning secretary. We call it the Development Budget Coordination Committee, and we meet almost quarterly. And that was before, and that has been institutionalized. So it was really very easy for us during the COVID, during this period, to coordinate even closer. And I think it's lucky that I was there before as budget secretary, so I recognize the challenges faced by the fiscal authorities, reduced revenues because of the crisis, plus higher expenditures demanded by the COVID-19 pandemic. So we actually, the central bank actually provided bridge financing to the national government, and as a byproduct of our liquidity enhancement measures, interest rates went down, so it's cheaper for the national government to raise financing and so forth and so on. So the coordination was really very smooth. And when I say all of government, it's more like all of society, because even the private sector cooperated. In fact, in the vaccination program, the private sector is contributing a lot also.
Yes, there's a lot of room for public-private partnerships, I think, particularly in the health area. On the inflation outlook, you seem to be reasonably optimistic that you'll get back to your target of 3 plus or minus 1. You're a bit above that target at the moment. How worried are you that there may be some second round effects, wage increases, for example? Do you see any sign of wage rounds becoming somewhat more difficult for employers? And also the well-known supply shortages that we see all over the world, bottlenecks and so on, chip manufacturing, all those things which I'm sure are affecting you as well. Is that likely to cause your inflation rate to go up beyond the level that you are currently targeting?
You know, the Philippine Central Bank has really good record in inflation targeting, and maybe we're wrong, maybe 10% of the time, but we're correct 9% of the time. So I'm really confident that we'll meet the target, which is 3% plus or minus 1%. Right now, it's slightly elevated, and I think that's happening all over the world, US, UK. But we are looking at the sources of the deviation, and it's basically on the supply side, right? ASF or African swine flu on the pork side, and of course oil prices. But I think the medium and long term forecast on oil, it will go down. So we're really confident that of course the logistics on shipping costs has gone up, and that's global. But we're confident that once these things subside, I think we'll hit our inflation target of 3% plus or minus 1%. In fact, our forecast for next year is that inflation will be right there, smack in the middle, 3% in 2022 up to 2024.
Let's say you're wrong. Let's just be provocative for a moment. And let's say that something happens in the world economy, maybe the American economy, that causes inflation to spike, not just with the Philippines, but elsewhere. Would you not hesitate to then take some action on this, maybe start withdrawing your stimulus a little bit earlier, were that unfortunate episode to happen?
Yes, of course. We could constantly monitor what's happening abroad and domestically. And so, in fact, we have a policy meeting every 6 weeks. And so we look at this, and we will of course, because of if we are wrong, then will be willing to adjust. All right, and so we're looking at, for example, the tapering of the stimulus abroad, UK and US. But the way I see it, it won't happen immediately. And at the same time, it's well communicated when it will take place. So we are ready. I've seen several crises in my lifetime, and the Philippines is much ready this time. In the past, every time there is a crisis, we run out of dollars to service our foreign debt. Not anymore. We have a lot of dollars. In fact, our gross international reserves, as I said, is equivalent to more than a year's worth of imports. The rule of thumb is, or the received doctrine is, 3 months worth of imports is sufficient. We have more than a year, and we have a constant inflow of foreign exchange coming from the overseas Filipino workers, from the business process outsourcing, and now very healthy foreign direct investments. And of course, our exports has also picked up. So we're confident that we are ready for any eventuality.
Yes, those figures are actually very reassuring on the inflows, without a doubt. You mentioned the tapering in the United States. Mr. Powell seems to be going about it in quite a benign way and fairly conservative way. Do you think that the Fed has really learned its lessons since the taper tantrum of 2013 about not doing this in too disruptive a fashion that could be unpleasant, not only for the US economy itself, but also for foreign economies, and particularly relatively small, vulnerable economies such as yourself? Do you think the Fed is now playing a role almost as though it's the world central bank and not just the central bank of the United States?
I think central bankers all over the world have learned from that experience. I think any move should be well communicated to everybody, and I think central bank governors talk to each other nowadays. I know that. So we know exactly how the other central banks will behave. So there's enough forward guidance, and so we can prepare for it. And so if there's a withdrawal of some stimulus on the part of the Treasury abroad, for example, the Fed, for example, that will affect the developed countries and the emerging economies differently. And within the emerging economies, there will be, of course, some differentiation, and that will depend on the initial conditions and on the health of their external economy and so forth and so on. So, but what is important is that there should be forward guidance, and this does not have to happen abruptly because it's going to be disruptive.
Yes, I think the central banks did used to talk to each other in the past, but maybe they listen more these days. That could be an answer. I wanted to ask you about two aspects that you mentioned: digitalization and also sustainability. You are a country which does rely a great deal on remittances from abroad. As you have said, that has been continuing at a very buoyant pace, which is extremely good news. Do you think that these new developments with central bank digital currencies, particularly the cross-border aspect of CBDC, where we see some very encouraging signs in the Southeast Asian region from Singapore and elsewhere, do you think that's going to make a big difference in terms of speeding up these remittances, making them more efficient, and also lowering the cost for the workers and the families involved?
Good you asked that question. When I assumed office in 2019, I committed to shift from a cash-heavy to a cash-light economy, right? So, and maybe cashless in the future. And I said that I'd like to achieve a goal that at least 50% of all financial transactions should be done digitally, and that around 70% of Filipinos should have, adult Filipinos should have a financial account. I think given what happened, given the pandemic, which has been a major catalyst, we will achieve that even before 2023, which is the end of my term, maybe sooner rather than later. Now, on the question of the CBDC, as you know, we have a very, very efficient and safe national payment system. We can now do things digitally. Now, on the CBDC, I created a technical working group to look at it, and the result of our study is that not many countries, at least in this part of the world, will be adopting it in the next maybe 3-5 years. Okay, but we continue to talk to each other. Now we're talking with Singapore for possible tie-up on the cross-border thing, and we'll probably arrive at CBDC in the future, but not within the near term.
Good. Well, it's very good that that is being studied. On sustainability, you've been quite exemplary, I believe, at the central bank in introducing this sustainability framework. You mentioned Mr. Biden before regarding infrastructure, but that's been another area where Mr. Biden has made an enormous change in the United States regarding taking this seriously, and the Federal Reserve is now taking sustainability seriously in a way it didn't before. Do you think that central banks around the world, including in the Philippines, need to take even more account of sustainability factors in your overall monetary policy, not just in your reserve management or in your supervision, but in your basic monetary policy? Should it be embedded like a central point in your DNA into all the monetary policies that you carry out?
I agree. We should take this seriously. Although it's not in our original mandate, but I think given what's happening, we should really take this sustainable finance very seriously. In fact, the BSP issued the Sustainable Finance Framework last year, which sets the expectations on integration of sustainability principles into the framework, systems, and operations of banks. And so we, of course, it's a very general framework, and we will issue, moving forward, more granular regulations. And this is to make our BSP, or central bank supervised institutions, committed to this ESG-related regulations. Meanwhile, you mentioned on our commitment to green bonds. On our part, we have invested $550 million in the Bank for International Settlements on Green Bond Fund. And of course, as I mentioned earlier, last April, the Philippines committed with the UN framework on climate change to reduce the projected carbon emission by 75%. And here, this is an all-of-government approach again, with the Secretary of Finance taking the cudgel. The Philippines, as you know, is one of the vulnerable countries from climate change, and it is in our own interest to be serious about this moving forward.
Just a final question, since we're shortly going to run out of time. You mentioned your mandate ends in 2023. You mentioned the stimulus measures, which maybe will be, some of them will be withdrawn by then if the economy remains on track. You mentioned also the goal of the cashless or a less cash-heavy society. What other goals do you have where you would then reach the end of the mandate as a happy man?
Well, I kind of noticed that when we joined the central bank, that they look at the central bank governors like God, infallible, right? That was not what I wanted. I wanted to make the central banking closer to the people, for the people to understand what the central bank is doing for them. And I think the way to explain to them is that we're really committed on inflation. We want to keep inflation reasonable, and it is the poor who benefits more with low inflation. So That's number one. And number two is that if we can keep the economy more or less stable rather than peaks and throws or boom and bust, then it's really the poor who benefits from this in terms of not being unemployed during the bust years. And so it's really the poor who suffers most when the economy is not steady. And so that's our commitment: stable economy and low inflation. I think we can trying to explain that to the Filipino people. That is the role of central bank, not only to print money, but to keep the economy stable and inflation low.
Well, I noticed you do send out quite a few tweets yourself, and so this is all part of the communication. We at ONFIF look forward very much, Governor, to carrying on the conversation with you. We hope in real life, we hope to come to Manila and carry on the very good cooperation we had with you in the past. But this has been a very valuable stepping stone, I think, this podcast that we're doing here, which is going to go out all around the world. I thank you very much indeed for giving us this time and also explaining how the Philippines is making the best of this crisis on the way to becoming a modern, inclusive society and economy. And I think the central bank is playing a very, very valuable role in that. So thank you very much, you and your colleagues, for making this possible. And good luck with all your goals and your further achievements until your mandate expires in 2023.
Okay, thanks, David, for giving us this opportunity. Thank you. Keep safe.
Thank you very much indeed. Enjoy the rest of the day. Goodbye, everybody. This is David Marsh from the Conversation with the Governor, Benjamin Diokno, saying goodbye to you. And please do enjoy the recording. Goodbye.